we are covering the tax treatment of employer-provided health and disability benefits for your health insurance licensing exam. This is a critical topic because the rules differ significantly between the two types of insurance, creating perfect opportunities for exam questions. First, let's discuss employer-provided health insurance. For the employer, the premiums paid for a group health plan are considered a tax-deductible business expense. This is straightforward and a major incentive for businesses to offer coverage. For the employee, the value of the health insurance benefit is received entirely tax-free. It is not included in their W-2 as taxable income, and they pay no federal income or payroll taxes on the premiums the employer pays. An exam trap might ask if an employee can deduct the value of employer-paid health premiums. The answer is no, because the employee never received it as income in the first place. Now, let's shift to group disability income insurance, which is where the exam lays its most clever traps. The taxability of disability benefits follows one crucial rule. Here's a phrase to remember: whoever pays the premium determines the taxability of the benefit. More specifically, the tax treatment of the premium dictates the tax treatment of the benefit. If an employer pays the entire premium for a group disability plan, it's called a non-contributory plan. The employer deducts the premiums as a business expense. Because the premiums were paid with pre-tax dollars from the employer, any disability income benefits the employee receives are fully taxable as ordinary income. For example, if an employer pays 100% of the premium and a disabled employee receives a $3,000 monthly benefit, that entire $3,000 is taxable income to the employee. Conversely, if the employee pays the entire premium with their own after-tax dollars, any benefits they receive are completely income tax-free. This is because no tax deduction was taken for the premium, so the IRS does not tax the benefit on the back end. The most complex scenario, and a favorite for exam questions, is the contributory plan, where the cost is shared. Let's say an employer pays 80% of the premium and the employee pays the remaining 20% with after-tax dollars. If that employee becomes disabled and receives a $2,000 monthly benefit, the taxation is proportional. 80% of the benefit, or $1,600, would be taxable income because it's attributable to the employer's tax-deductible contribution. The remaining 20%, or $400, would be received tax-free, as it's attributable to the employee's after-tax contribution. A common point of confusion is mixing up pre-tax and after-tax employee contributions. If an employee pays their portion of the disability premium through a Section 125 cafeteria plan, those are pre-tax dollars. In that case, the employee's contribution is treated the same as the employer's, and the resulting benefit would be taxable. So, always check if the employee's contribution is pre-tax or after-tax. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.